Commissioner, I apologise for that confusion before.
Somebody on behalf of CommBank is going to call the witness.
Yes,
Collins.
hopefully I'll get his name right, Commissioner. I call Peter Nathaniel Clark.
Clark. Mr. Clark, can I ask you whether you would prefer to make an oath or take an affirmation?
An affirmation.
Confirm the witness, please.
I solemnly and sincerely
I solemnly and sincerely
declare and affirm
declare and affirm
that the evidence I shall give
that the evidence I shall give
will be the truth,
will be the truth,
the whole truth,
the whole truth,
and nothing but the truth.
and nothing but the truth.
Thank you, Mr. Clark. Do sit down.
Mr. Clark, your full name is Peter Nathaniel Clark,
That's correct?
and your business address is 201 Sussex Street, Sydney,
Yes,
and you are the Chief Credit Officer of Commonwealth Bank of Australia.
that's correct.
You have received a summons to appear before this commission.
I have.
I tender the summons, Commissioner.
3.100, summons to Mr. Clark.
Please, the Commission. Mr. Clark, you have made 2 witness statements in relation to this commission.
That's correct.
If I deal with them, I'll deal firstly with the statement which is in relation to the BankWest Mr. Weller case study, or rubric 3.28. You have made a witness statement dated 27 May 2018.
That's correct.
And are the contents of that statement true and correct?
Yes.
I tender that statement together with its exhibits.
Statement and exhibits, Mr. Clark, dated 27 May 18, relating to rubric 3.28, exhibit 3.101.
Commissioner, I'm sorry, I made a mistake. It's actually 324, not 328. I do apologise.
320, rubric 3-24, thank you.
And Mr. Clark, you have made another statement in the matter, rubric 325, in the matter of the BankWest Mr. Doherty case study.
That's correct.
And you have a copy of both those statements with you in the witness box.
I do.
Is the contents of that statement true and correct?
It is.
I tender that statement together with its exhibits.
Statement of Mr. Clark and its exhibits relating to rubric 3-25 is exhibit 3.102.
Thank you, Commissioner.
Yes, Mr. Donnelly.
Thank you, Commissioner. Good morning, Mr. Clark. My name's Albert Donnelly. I'm one of the counsel assisting the Commission, and I'd like to ask you a few questions this morning about the case studies of Mr. Stephen Weller and Mr. Michael Doherty.
Good.
Have you been in the hearing room to hear their evidence, Mr. Clark?
I have.
And am I right that you are the Chief Credit Officer of the Commonwealth Bank?
That's correct.
And you've been in that role since March 2014?
That's right.
And in that role, you're responsible for the credit management of facilities that have been classified as troublesome or impaired assets?
That's correct.
And you're also, in that role, you're responsible for a group within the bank called Group Credit Structuring, is that right?
That's right.
And am I right that Group Credit Structuring some time ago merged with, or CAM, Credit Asset Management of BankWest, became part of that, is that right?
That's right.
In your statements, you've given evidence in response to the circumstances in your 2 separate statements. One, you've given evidence in response to Mr. Weller's then outline of evidence and Mr. Doherty. Is that right?
That's right.
And did you have any personal involvement in either of their cases at the relevant time, Mr. Clark?
In Mr. Weller's case, I'm not aware of any personal involvement at all. In Mr. Doherty's case, I think subsequent to the receiver's role, I think I had 1 or 2 emails in the final write-off from the losses right at the end, but that was the extent of...
I see, and we'll come to that, and I might ask you some questions.
Just ask you to keep your voice up a bit, Mr. Clark, if you wouldn't mind.
Certainly.
Thank you.
So aside from those matters, which we might touch on, aside from those matters, your evidence in respect of both these former BankWest customers is based on your review of of the relevant material. Is that right?
That's right.
And discussions you've had with other people?
Yes, discussions with people within BankWest and CBA.
Thank you. Perhaps I can start by taking you to Mr. Weller's evidence. You heard evidence yesterday in relation to his business facility through a company known as Bainbridge Enterprises, No. 1, Proprietary Limited.
That's right.
And that was the vehicle through which, initially with a business partner, later just he and his wife purchased the Nambucca Hotel.
That's correct.
And that facility was initially entered into in 2005, is that right?
That's right.
And it was increased, that is the level of the facility was increased in 2008, so as amongst other things, Mr. Weller could buy out his business partner?
I think that was the sole purpose for the increase, but yes.
And at that point, the facility totalled $3.725 million.
I think that's right.
Can I ask that the facility itself be brought up CBA.4000.0074.7956? And this is the facility that was entered into in 2008, is that right?
It looks like it. I can't see dates on it. But
May assist you if we go to the signature block, just so you can properly identify it. Or perhaps more conveniently, we just go to the page prior. It's a letter dated 2 June 2008, which was sent by BankWest to the directors of Bainbridge.
that seems right, yes.
And just to be clear, CBA at this stage didn't own BankWest.
I think CBA purchased BankWest, I think, in December 2008, so not at this stage.
So, so in June, before CBA became its owner, BankWest had entered into this facility, or these facilities. If I can go to the next page, and in fact that's where I took you to, I think, initially and mistakenly. What does the expiry date of to which there's reference on this page, about point 7 of the page, what is a facility expiry date?
Well, it's when the facility finally expires, is due to be no more. I'm not quite sure how I can explain an expiry date. It is what it is.
Quite an existentialist answer, Mr. Clark. Perhaps I'm overcomplicating it. The expiry date is indicated.
Parrots, Mr. Danelli, I'm sorry.
15 years from initial drawdown date is indicated there. That's the date upon which the entirety of the facility is to be paid off, the principal and interest, and to use your term, is to be no more.
That's correct.
Thank you. And there's an indication there of, and this is common in a lot of the documentation that you will have seen in preparing your statements. It says 15 years from initial drawdown date. What is the initial drawdown date for the purposes of these facilities?
So I think in relation to this particular facility, it was probably the settlement of the advance of the additional funds, so the buyout of the partner. So I think that was the additional $700,000, so it would have been the day that actually occurred, and the refinance of the existing debt. I think that's what that means.
I see. And that occurred, I think, sometime in June. It matters not. I think it might have been on the 23rd of June. That payment was made, and that's the beginning of the 15 years, is that right?
That's correct.
Was it, and accepting that you personally obviously had nothing to do with this particular facility at all, but certainly at this time, do you understand it to have been the usual practice to have facilities of this length?
I think from what I understand of BankWest, it probably wasn't that unusual for BankWest. In my banking experience, it's perhaps a little more unusual.
Why is that? Why is it perhaps more unusual?
I think, longer term, 30 years are for home loans. Project finance type transactions where it might take a long time for repayment could be 10, 15 years. Commercial transactions normally beyond 5 years is fairly rare in my experience.
I see. And can I explore some other parts of this document with you briefly? If one goes to the next page, there is so it's 7959, which is, you'll see, which again I imagine is the case with all such documents. There's a reference to the securities, and there was security over the hotel itself, as well as assets, as well as a fixed and floating charge. Do you see that?
That's right, yes.
And that included all assets and undertaking, including liquor and gaming licences. We'll come to this later, but that included the pokie machines, for example, that were being operated at the Nambucca Hotel.
Yeah, I think all the assets of that company were designed to be incorporated in that security.
I see. There was... Mr. Weller didn't give his home as security, did he?
No, he didn't.
For this facility. And there are, what I described at 6.5 at the bottom, financial undertakings. Do you see that?
I do.
And if one goes over the page, and you would have heard Mr. Weller give evidence about these covenants yesterday, perhaps at the top, if that can be increased, there's the interest cover ratio and the debt service ratio. What is an interest cover ratio?
So that's a ratio that attempts to measure the cash flow surplus above the interest obligations of a borrower. So in this case, I think they're using EBITDA, which is earnings before interest and tax and amortisation of a borrower. So it's a proxy for pre-debt servicing cash flow divided by interest. So an ICR above 2 times suggests the business generates 2 times as much cash as is required for interest payments.
I see. And what's the purpose of that covenant from the bank's perspective?
I think it's part of prudent management by the bank of the credit exposure that it's written. It sort of allows it to compare the performance of the business to the forecasts and the expectations. I think it also is useful from a borrower's perspective as to how he's tracking. If his ratio is performing above that level, he can feel comfortable, I think, in how his business is actually operating.
And then the debt service ratio, can you explain that?
So that's similar. The numerator, I think, should be CFADS, not CAFDS. I think that's a typo. But CFADS is cash flow available for debt service, which generally takes EBITDA, adjusts for working capital movements as well to try and... EBITDA is more an accounting construct. CFADS is more a cash flow, attempt to more accurately measure cash flow. So CFADS is used as a proxy in that sense from EBITDA, and divided by total debt service, which includes interest plus scheduled principal payments. So that's the entirety of the debt service obligations of a borrower over the period of time that we're talking about.
And does it have a similar purpose to the purpose of the interest cover ratio?
Yeah, so it includes the total debt service, obviously, is a higher number because it would include any scheduled principal payments, so that's why the ratio is slightly lower.
And excuse me, and each of them have a requirement of 2, in this case, respectively, 2 times and 1.5 times. Are those ratios set, or are they worked out on a case-by-case basis, in your experience?
I think the answer is probably both to those. So I think in some particular industries there may be a policy around requiring particular covenants and particular level of covenants. In others there may not be those requirements, but I would suggest that prudent banking would suggest these are probably a good idea to have these type of financial covenants.
And in fact, are they part of business loans currently offered by CBA?
Yes.
And essentially your evidence as to their purpose is essentially it gives it evidences the health of the business and relevantly the ability to pay off the relevant facilities.
That's correct.
And if you breach if one breaches one of these, that's a breach of the facility.
In this case, yes.
In the same way that if you fail to meet a payment, that's fail to meet an interest payment or an interest and principal repayment, that too is a breach.
They are both breaches. I think the importance of the two probably would be treated differently by a bank, but they are both breaches generally.
Why would they be treated differently by the bank?
So I think failure to meet a payment of interest or a scheduled payment of principal, or failure to meet the amount owing at the expiry of a loan, I think is seen as a fundamental breach of the terms of the contract. The financial covenants we just talked about, ICR and DSCR or DSR, are more indicative of the financial performance. I think they're seen as guidelines. They may, legally may well be breaches of the loan contract, but I think it's very rare in my experience for a bank to actually call a default and demand repayment as a result of a breach of one of these ratios alone.
And you're aware that during the time that Mr. Weller had his facilities with the bank, he did indeed breach the ICR and or DSR ratios on a number of occasions.
Yes, I did see that.
And you're also aware, however, that he never breached any of the repayments that were owing during the course of the facilities.
Well, I'm not sure that's actually correct, Mr. Donnelly. I think there were significant payment breaches at the back end of his facilities.
That was after the period that the bank said that the facilities, though, had expired, hadn't they?
I'm trying to recall the particular timing of when the breaches first occurred, but I think in maybe confusing it with the other case, Mr. Donnelly. So
You wouldn't be the first to do that, Mr. Clark, rest assured.
but you know, from memory, there were significant financial breaches, arrears, non-payments by Mr. Weller.
But let's be clear about that, just so we can place it. But those financial breaches occurred, as I understand the bank's position, occurred on the non-repayment of the entirety of the loan at the end of the facility.
I think that is true, but from memory, I think there were also something in the order of 226,000 of arrears at the time receivers were appointed in this matter. That's in addition to the non-payment of the principal.
That is correct, and that's the subject of your evidence. But those arrears arose, just to be clear, after, maybe I'll place it for you, the deed of forbearance, which was entered into between the bank and Mr. Weller, which is part of your evidence and also was exhibited to Mr. Weller's statement, was entered into in January 2013.
That's correct.
And the $226,000 of arrears to which you refer when the receivers were appointed were as a result of breaches, sorry, I withdraw that, were as a result of payments being failed to be made after that date.
You've jogged my memory, Mr. Donnelly. So I think the facility expired around the 10th of January.
It did, 2013.
And so those breaches were after that time.
That's correct.
You're right.
So to return to the initial question, during the course of the existence of the facilities, and they changed in time, and obviously I'm going to ask you some questions about the length of the facility in a moment, but during the course of the facility from this date until January 2013, that is immediately before its expiry, there were no monetary defaults on the loan.
I think that's correct, yes.
And in fairness, as you've said, you did say, however, you answered affirmatively that there were a number of non-monetary defaults.
After that time.
Sorry, the non-monetary defaults happened during the course of the facilities. Non-monetary defaults?
That's right.
Yes. But no monetary defaults.
That's correct.
Just one final question about the facility itself. It didn't have an LVR covenant. That's right, isn't it?
I think that's correct.
And in your experience, was this something that was typically not included in BankWest facility agreements?
Well, this was 13 or 14 years ago. I'm not sure I can really speak sensibly to that question. I'm surprised there was no LVR, but that's from my current knowledge, not from knowledge.
Why were you surprised, using your current knowledge?
I think lending to a pub with this amount of leverage, I would have thought an LVR covenant would be a sensible covenant to have from a bank's perspective.
And in fact, that would be the policy of CBA now?
I'm not sure it's policy. I think it's good banking practice, if I can put it that way. It may well be policy, but it's certainly good banking practice.
Now, what I'd like to take you to is in 2010, there was a negotiation with Mr. Weller about the terms of the facility. Do you recall that from your review of the materials?
Yes.
And there was to be a variation of the facility.
That's right.
And to this time, the facility was, so in 2010, on the basis of your evidence that the initial drawdown was made around June 2008, there were still 13 years to run on the facility.
I think that's correct.
Before we go on, I might just provide some background. Around this time, in the background there was Project Magellan was occurring. Is that right?
I understand so, yes.
Now, I know you weren't involved in Project Magellan, but you're aware of its existence.
Yes.
And we'll ask more questions of your colleague, Mr. Cohen, about how that project worked and what it set out to achieve. But relevantly for the purposes of Mr. Weller, are you aware whether the Bainbridge facility was the subject of Project Magellan?
I understand it was reviewed as part of Magellan, yes.
And do you know what basis it was chosen as one of the facilities to review?
Not specifically, other than I think pubs, hotels generally were part of that review above a certain amount of exposure. But why specifically it was identified, I'm not aware, but I'm not surprised it was part of that.
And are you aware what assessment was given to Mr. Weller's Nambucca Hotel by Project Magellan?
I am.
And in fact, it was recorded, was it not, in a document to which I'll take you, PNC 48, which is CBA.4000.0029.8954. What's this document, Mr. Clark?
It appears to be the Project Magellan review of Bainbridge and Nambucca Hotel.
And if one goes to the second page, I think it's Mr. Goldsmith, who was then Mr. Weller's a business relationship manager. He said their account conduct has been satisfactory and information provided in a timely manner. And skipping that next sentence, we have a good relationship with the client. And of course, he hadn't been in any monetary defaults at this time. If one goes to the next page, sorry, that was it. Just confirming that, of course, he hadn't been in any monetary defaults as at the time of Project Magellan.
I think that's true.
And if then there was the review panel, sorry, the review that in this case was done by Ferrier Hodgson. If one goes to the second page of that, there's some conclusions under the heading recommendation summary. Do you see that?
I do.
And it says the hotel appears to generate stable earnings which are sufficient to service debt and scheduled principal repayments. Do you see that?
I do.
And then security value in relative terms is holding. And then there's a reference here to fixed interest rate ends in June 2010. Just recalling what we discussed previously, I think Mr. Weller had a period where it was interest only, didn't he, for 2 years?
That's correct, yes.
And just to deal with the outcome of Project Magellan, it was green. What did green mean at the time for Project Magellan?
Well, I assume it means no issues, no problems, it passes. I think I've seen others in my extensive experience of 2 Magellan files that I've looked at was a different colour. So I think green indicates pass.
Well, and you'll see in relation to Mr. Doherty, reference to double red, and we'll come to that.
Can I, sorry, Mr. Donnelly, just the comment about the fixed interest rate
Yes.
ends, I think, just to be clear, I think Mr. Weller had split the facility, so he had the ability to actually have part floating, part fixed. So I think that's what that's referring to.
Oh,
that
thank you for that
interest rate ends
clarification.
in June
In fact,
2010.
it might be that fairly I should have taken you to where it says future action right down the bottom. The second dot point, ensure amortisation commences in June 2010. That's a reference to the fact that there's got to be some principal payments.
That's right. The fixed interest rate's a slightly different issue.
Yes, correct, and that was my fault. I apologise. So at least at that time, when Magellan was done, the hotel did not need to be transferred to CAM, to Credit and Asset Management, by reason of Project Magellan.
That's correct.
Now, BankWest made an offer to Mr. Weller to extend the Bainbridge facility in August 2010. You're aware of that?
That sounds about right.
Okay, well, it might assist you, and obviously we're talking about some time ago, and also matters of which you don't have personal knowledge. But if I can take you to PNC 51, CBA.0001.0318.1981. What's this document, Mr. Clark?
Well, it appears to be exactly as headed, credit risk, a facility amendment, so that's a paper from the relationship team to credit normally for approval of some amendments.
I see. And what when was this document produced?
I think, Mr. Donnelly, I might need a little more help to answer that question.
Yeah.
It doesn't seem to be on the face of the document, unless
No,
it's
and in
the
your
body of it.
In your statement, you say, if you'll bear with me, Thank you.
Albert, it's the page, it's 1988.
In July 2010, so just to place this, this is about to be the period after, it's about 2 years into the facility, and this was prepared by, if I understand it correctly, the business relationship manager, Mr. Goldsmith, in light of the forthcoming expiry of the 24-month interest-only period. A suggestion or a recommendation was put in the form of this document, the Credit Risk Facility Agreement. Who would this go to, Mr. Clark?
So without being cute about it, I mean, this is one front page of a document that I can't see a date on, but assuming...
It's according to your statement, it's dated the 16th of July 2010.
But as I said, I think before, this would normally be produced by the relationship manager for the relationship and put to credit for approval.
I see. And it would contain a suggestion by, I'm speaking generally now, a suggestion from the relationship manager to credit as to what should occur with the facility going forward.
That's correct.
So if one goes to point 1983, under approval for restructuring facilities due to upcoming expiry of fixed rate portion of the Flexi Protect product, do you see that?
I do.
And the author says in the paragraph underneath the dot points, the original approval, perhaps that can be blown up, those two paragraphs, if that's not inconvenient. The original approval allowed for a 15-year term in total, with the first 2 years IO, which is a reference to it being
Interest only.
interest only, thank you. As noted in previous papers, amortisation is due to now commence for this facility. The amortisation is seen as crucial as the valuation completed in August 2009 came in at 4.53 million, meaning that the LVR is 82.22%. And then there's reference, although Project Magellan has decreased this amount to 4.3 million, meaning the LVR should be 86.6. Do you know what is meant there by Project Magellan decreasing the valuation?
Yes, I think if we went back to the Project Magellan pages you had up, I think somewhere in that there is a comment from the reviewer that they thought the valuation that we held was probably a bit high and that it should be the 4.3 figure, I think, was mentioned in that Project Magellan paper.
I see. And then if one goes to, or if we can pick up the next two paragraphs, starting with bold borrower. So then this, this is preceded by, we seek business credit approval for the Flexi Protect facility to be closed and our TAE to be restructured as follows. Now, then there's a reference to the facility, the size of the facility, and that the term be 13 years. Do you see that?
I see that.
And a reference to the commercial advance product rate being used plus a margin of 2.74%. Do you see that?
I do.
And then a bullet payment. What's a bullet payment, Mr. Clark?
So that's when a facility doesn't fully amortise over its term and there is an amount left at the end. So an interest-only 5-year loan of $100 would have a bullet payment of $100 at the end, effectively the same amount. A facility that amortised, to half over its term would have a bullet payment of half the amount left at the end. So that's what the bullet refers to.
And there was a realisation then by both the bank and by the client, by Mr Weller, that, or at least perhaps I can quote what's said in the paragraph preceding that, our client, Stephen Weller, believes, and we agree, that they, being the owners, would not be able to service this facility without placing undue pressure on the business, thereby affecting both our serviceability and security position. So that was a relevant factor in deciding what would be the appropriate facility going forward.
Yeah, I think to put it in some context, if I could, this facility originated at a smaller amount in 2005 as a 2-year interest only with 13-year repayments. We are now, I think, in 2009 or 2010, there's been no principal payments over that period of time. So effectively it's grown and that interest only period has been extended and rolled. At origination, the fully amortising was going to be about $30,000 per month on the original facility. The calculation in this document, I think, is something in the order of $39,000, I think, from memory.
That's right.
Per month. So, you know, higher than it was back in 2005 was the estimation, but the facility is larger. But Mr Weller is not comfortable, and the business agrees, I think, that that's too much for him to pay to fully amortise. So that's why this bullet structure was proposed to accommodate that.
Now that wasn't put to, that offer that was discussed here wasn't actually put to Mr Weller, was it?
I'm not sure whether that was actually put to Mr Weller. I think there were a series of
There
negotiations and counter-proposals and comings and goings, if you like, before a final agreement was reached.
In fact, if I can take you to the next document, see PNC 52, CBA.4000.0075.1407. This is a further submission which seems to have made by Mr Goldsmith, is that right?
This looks like an approval paper, I think.
Well, this is only a 2-page document, and I was going to ask you about it and how it fit with what was in the previous document. If one goes to the next page, and you'll see on the 4th dot point down, max term 5 years. Do you see that?
I see that.
Are you aware as to why the term that had been suggested in the previous document of 13 years was now being suggested to be 5 years?
I don't know.
And then if one goes to the next document, PNC 53, which has just come up, you'll see that there's an email from Mr Greentree to Gary Goldsmith, who is the person who put in those submissions. And the main paragraph there says, as discussed yesterday, may you please approve the change in term from 5 years to 2 years for the proposed CADV. So this suggests that the term was being then approved down from 5 years to 2 years. Do you see that?
I do see that.
Do you know why that change was being made?
I don't know. As I said in response to an earlier question, there was lots of toing and froing conversation with Mr Weller. I don't know whether this was in response to that or not.
Look, there were discussions with Mr Weller, but just to be clear though, at this point there hadn't been anything put to Mr Weller yet. Are you aware of that?
Not specifically in terms of the timing of when that
Well,
happened.
the first offer that Mr Weller received, which is the one upon which he gave evidence, which you heard that he was unhappy about the length of the term, was sent on the 4th of August 2010. My question to you is, and it might be that you cannot assist, but why it appears that the documents internally within BankWest accept the 13 years, which was still to run, then it became 5 years and then it became 2 years. Are you able to assist as to why that occurred?
So I think I responded on the 5-year one. I don't know.
Yes.
On the 5 to 2, again, I don't know unless there had been communication with Mr. Weller around that change, and I don't know if that was the case or not.
Well, his evidence where the discussions occurred, I think, will become apparent now. I don't know. He didn't give evidence as to exactly in July what discussions.
And they may well have been subsequent to this date.
So the offer that was made on the 4th of August, which is the next document, PNC 54, you've seen this document before. This is PNC in preparing your statement, of course. This is the variation that was sent. And if you go to the second page, one sees that the facility expiry date there is 24 months from the initial drawdown date. Do you see that?
I do.
Now, you heard then the evidence of Mr. Weller yesterday about the discussions that occurred, and I won't take you to the emails unless you'd like me to, but there was discussion then in emails between him and Mr. Goldsmith about why there was why the period had been shortened from 15 years to 2 years. Do you recall that? Do you recall those emails that Mr. Weller referred to?
Well, I have a general understanding of that conversation and that communication.
I mean, I can take you to them if you wish, but you have them in your statement.
Yeah.
And in essence, I think it's fair to say that Mr. Weller said the original documents noted the expiry of 8 June 2023 and inquired why that wasn't the case. And then there was some email correspondence about that. And presumably what then occurred is that Mr. Goldsmith prepared this document, which is PNC 57. Now, this is a BankWest credit risk form. Do you see that?
I do.
And if you go to the second page, under the heading margin, it says the current margin for the client is 2.24%. You'll recall that figure is the figure from the facility, which is the margin. And there's a reference in our letter of variation, this was increased to 3.19. In our discussion, the client asked we consider a margin of 3%. Now, I didn't take you those emails, but that was part of that email correspondence as well. However, to do this, it is not possible to meet clients' requirements for the original loan term to be detailed in the new LOV. And then there's reference to the attachment. But can I take you to the next page where, having set out consideration of Mr. Weller's position, it says, consequently, in order to strike a balance between what the client has requested and believes is affordable and what we require by way of debt reduction, I propose we structure our TAE as follows. And you see there that the reference is to have to reinstall the 12 years, 9 months terms. Do you see that?
I do.
But if that be the case, then the relevant margin is going to be 3.95%. Do you see that?
I do.
And then that met with some concern. You heard the evidence that Mr. Weller gave about that. Sorry, I should say that was sent then in the form of a letter of variation on the 19th of October, and that met with some concern from Mr. Weller because of the very high margin that was to be imposed. Do you recall that evidence?
I do.
So then the next stage, and this is obviously what is happening then in terms of the next iteration, is Mr. Goldsmith goes back to the same body by way of a further version of this document or a further update, PNC 60. And if you go then to the second page of that, and under the heading Term of Facility, as noted previously, client wanted to have the original term reiterated in the new LOV. Despite my advice that due to LFTP considerations, what's that again, Mr. Clark?
Again, it's a slight typo, so it's LTFP is what it should be, which is long-term funding premium.
Considerations, the pricing would increase. The client was adamant on this point. However, following production of the letter, he now understands more fully the effect of the, I think you would say it's LTFP,
Yep.
2% for 10 years as opposed to 0% for 1 year, and has requested we amend the term from 1 year to 1 December 2012. Do you see that?
2010, yes, I do.
And then there's a reference in the next paragraph to given our preference for facilities over a short term and our desire to review performance of the hotel in 12 months to increase both payments and step-up ratios, I see that a 12-month term is a perfect fit and will be a benefit to BWA and consequently recommend approval. You see that?
I do.
Where there's a reference to our preference for facilities over a shorter term, what does that mean?
I think that's just a general banking comment that longer tenor comes with longer risk, and so bankers always prefer shorter tenors if possible.
Why is that?
Well, I think the longer the term of the commitment you make to a client, the higher the risk involved, because over time, more things can happen, more things can go wrong, and so shorter tenors associated with, there is risk associated with longer tenor, and so bankers prefer shorter tenors. There's less risk involved.
And you'd accept, though, wouldn't you, that from a borrower's point of view, factors might militate in favour of having a longer term facility as well?
There are some conflicting views between borrowers and bankers, yes.
And well, Mr. Weller certainly would have preferred a longer term, wouldn't he?
Well, we offered a longer term to Mr. Weller, which he said he want, and so we made that offer to him, but the long-term funding premium associated with that made the pricing unattractive to him, and he, in the end, I think was preferred to go with that 1 year tenor with the lower pricing.
Can I take you ahead to May 2012? Perhaps before I do, I'll take you to a further update from 2010, just to, which is PNC-64. Before I come to this document, and one of the other things about a shorter term is, of course, it also increases the ability of the bank to exit a facility if it doesn't wish to be lend any longer. Is that correct?
That's true.
And that was not an irrelevant consideration at the relevant time within BankWest.
I'm not sure that was particularly more relevant at that point in time. As I said before, I think generally for banking, shorter tenor is lower risk, and so banks always prefer shorter tenor.
Now, well, one of the issues that was raised by Project Magellan, of course, was decreasing exposure to this type of lending, wasn't it?
Well, I can't really comment on Project Magellan in a broad theme. I mean, this particular Mr. Weller was passed green by the Project Magellan review. So,
what I'm asking you though about is in the bank generally, and it's not. It may demonstrate that and if you can't assist me with Project Magellan, that's fine. But within, is it fair to say that around 2010 there was a desire on the part of the bank to look very carefully at its business loan book and carefully manage its exposure?
I think it's common knowledge within the bank and banking generally that post-GFC there were concerns about property books of all banks, and BankWest, was heavily invested in property. So I think there were concerns about the exposures generally.
Thank you. And if I go to the second page of this document, what time is it, Anna? There's a number of dot points that are referred to, or there's a reference to, whilst we acknowledge that the performance of the hotel has declined, we believe the client does not belong on a weak list. Our reasons for this are, and can I just deal with those? The first is that the decline is in line with the industry. You heard Mr. Weller's evidence about that, and you'd agree, would you not, that around this time there was less consumer spending as a result of, amongst other things, the GFC?
Yes.
And the facilities due for amortisation and term for facilities is 12 months, so any exit could be looked at then. Do you see that?
I do.
And if it had it been still a 15-year loan, of course that that would not have been available in the same way. Is that right?
That's correct.
And there's reference to the client has a first-class servicing record to date with BWA. Do you see that?
I do.
Management position considered very strong. And client has a good record with regards to provision of information in a timely manner. Do you see that?
Yes, I do.
And you'd have no reason to doubt those statements, would you?
I don't.
Now, in 2000, if I jump ahead, as I said I would, to May 2012, the file was transferred to CAM. Are you aware of that?
I am.
And in fact, part of your evidence at PNC 96 is and what's called an inward transfer credit paper. Do you see that?
I do.
Are you familiar with such a document?
I am, yes.
You would. Did you Did you see the evidence of your colleague, Mr. Perry, earlier this week? It matters not, but he gave some evidence about this.
I heard briefly Mr. Perry's evidence. I haven't seen the totality of it. So.
Well, he gave some evidence about this, but I'm right to say, am I not, that an inward transfer credit paper is when the file is transferred to credit and asset management?
That's true.
And if one goes to point 0357, the reason for impairment, it says the only shortcomings we can see are as follows: decline in trade of the hotel, and this would have an effect on the valuation of the hotel. Do you see that?
I do.
Whose handwriting is that there to the right? Do you know?
I have no idea.
There's no reference. There's no reference to the fact that Mr. Weller wasn't able to pay at that time all his interest and principal repayments as they fell due.
If the question, I'm not sure it was, but if the question was, had he been unable to make any payments, I think we've agreed that that wasn't the case. He had made all his payments. If the question was, was there an increased concern about his future ability to do that, I'd look at the last column in this document, where EBITDA at 286 is getting very close to the actual level of interest payments, and so I think there would be a concern about the ongoing ability to meet his payments.
And in fairness, the person in handwriting said, what about decline in trade's effect on ability to repay loan? There might have been some concern about what might occur in future, is that right?
Yeah.
Now, you heard evidence from Mr. Weller that...
Sorry, just Mr. Donnelly, sorry, just to be clear about that, the decline appears to have happened not to an extent already where he couldn't meet his payments, but the decline in trade had already occurred. This wasn't a future forecast, it seemed to have actually started to deteriorate over a period of time.
I see. Now, one of the things that was done at around this time was obtaining a valuation for the Nambucca Hotel. Were you aware of that?
I am.
And Mr. Weller was asked to pay for that, wasn't he?
He was.
And you've heard his evidence that he wasn't shown that valuation at the time?
That's true.
And you'd agree, would you not, that valuations would have been carried out on many files, including Mr. Weller's, and we'll come to Mr. Doherty shortly, at or around the time that they're transferred into CAM?
That's probably true, yes.
Well, and also they'd be undertaken by way of the file review process, the general file review process, even if they're not in CAM.
So that generally doesn't necessarily dictate the need for evaluation, so I think I'd just be a little bit reluctant.
Sorry, my point is, I'm not trying to trick you in that regard. My point was simply that valuations were commonly carried out on many files when they were transferred into CAM, to which you agree. And I said, but they could also be obtained at other times, including as part of a file review process.
That's right.
And you'd agree that significant decisions were made about Mr. Weller's facility on the basis of that valuation?
I'm not quite sure what you mean by that.
My question is, as you know, the facility wasn't renewed, and one of the reasons that was given for that was that there was a breach of the LVR covenant. Is that right?
I think there were probably a number of reasons the facility was not renewed. I think the breach of the LVR covenant, I think as we've talked about through the history of Mr. Weller's relationship, he breached many of those financial covenants along the way. They were never used as a termination event, and I think they weren't in this case either, but that the breach of the LVR indicated, LVR was very high, and that was one of the reasons why we didn't want to renew the loan, but there were other reasons as well.
But the valuation, you'd accept, though, the valuation was a relevant factor in making those decisions on behalf of the bank?
It was part of the decision process, yes.
Now, in your statement, you say that it's no longer the policy of CBA to withhold valuations from a customer who has paid for the valuation.
That's true.
That policy, if it had been in place at the time, would have been breached by what occurred in this case to Mr. Weller.
That's right. There was not, the same policy didn't exist at that point in time.
This has also been an issue that has been the subject of regulatory reform as well. Are you aware of changes that are proposed to be made to the banking code?
I am.
And one of the concerns that's raised is if significant decisions are made in relation to customers without them seeing valuations, there's a lack of transparency. Would you agree with that?
I would.
And perhaps I can call up the code, the proposed final version of the code. We heard some evidence about this from Mr. Curry last week. WIT.0900.0003.0290. And if I could take, perhaps if I can take introduce this. This is the document that has been the subject of, is not presently in force. It's been provided to ASIC for the purposes of being approved and will become, in due course, subject to its approval, the new banking code of practice.
That's correct.
If you go to page 18 of that document, it's 18, please, which is chapter 24. You see here that there's a reference to our processes in relation to external expert valuations will be fair and transparent. Do you see that? At 88.
I do.
And at paragraph 90, we will provide copies of property valuations and valuer instructions, open brackets, except where enforcement proceedings has already been commenced. Do you see that?
I do.
There were no enforcement proceedings in... Now, I'm obviously asking you about this, Mr Clark. I'm not saying this was in place. It's not even in place now. And in fact, what I'm going to say is that even if amended in this form, it wouldn't apply to Mr Weller because his borrowings were over $3 million.
I think CBA's policy, irrespective of that, would be going forward now, we would still provide the valuation to him.
And that would be on the basis that the sort of concerns about transparency would apply to people like Mr Weller just as much to people under $3 million.
Just seems a fair thing to do.
And you'd accept, we haven't got to Mr Doherty's circumstances yet, but you'd accept that that would be a fair thing to have done in his case too.
Yes.
A deed of forbearance was entered into in... Thank you. We no longer need that document. A deed of forbearance was entered into in January 2013, you'll recall.
That's right.
And I'm asking, in your experience, is it common for steps like that to be taken in a period, 6 or 7 months after a file has gone into CAM or now GSC?
I'm not sure I'd use the word common. It's not uncommon, is probably how I'd respond to it. I mean, deed of forbearance, I think in this case we didn't want to extend the loan itself, but we also didn't want to take enforcement action. So a deed of forbearance was both for our benefit and for the client's benefit to codify, if you like, the agreement between the two parties.
Well, if not for the deed, you wouldn't have been enforcing on the basis of non-monetary defaults, or the only defaults before the expiry were non-monetary defaults, though, weren't they?
That's true.
And BankWest first met with Mr Weller and his wife in September 2012, and the deed of forbearance was entered into in January. Again, was that, in your experience, expeditious or normal, or how would you describe that period of time?
It's very difficult to respond on timing. I mean, what were the circumstances, what was the availability, what was the relationship like between the parties? If the question is related to the deed of forbearance being provided to Mr Weller on the 8th of January when the loan expired on the 10th of January, that doesn't seem very... the timing of that's unfortunate. That doesn't seem very, very fair.
Can I ask you a couple of questions before we come to Mr Doherty? There's evidence from one of your colleagues from BankWest, Ms Taylor, Sinead Taylor, which sets out the current current standard forms that are used in relation to business lending by BankWest, Are you familiar with what's used by BankWest as distinct from CBA?
I think familiar would be the wrong description. I mean, broad awareness would be probably as good as I would sort of claim, I think.
I see. Perhaps I can just take you briefly to a document, and that is CBA.0517.0052.0259. Now, this is some correspondence that have been written by BankWest to ASIC. Now, I'm not putting to you that the unfair contract terms provisions would have even applied to Mr. Weller at the time, because his loan was in excess of the relevant limit. But one of the issues that was raised by Mr. Weller's evidence, if one goes to point 0263, was the issue of unilateral variation, and the relevant BankWest employee who wrote this letter deals with that there. And are you aware that at least for general terms to which those provisions apply, there's no more review clauses?
I am, yes.
And there's also amendments that have been made to the unilateral variation clause 18.21. And it's explained now, 18.21, I didn't take you to, but you might recall, I think it might be, and I'm not sure Mr. Weller went to it in evidence, but that is a clause which entitles the bank to make unilateral variations. Are you familiar with those clauses?
In broad terms, yes.
Yes. And have you had any involvement with this particular project of updating standard form clauses?
So in relation to this letter, which I think was to ASIC around
Yes.
unconscionable conduct, I've had no involvement at all in that. The Carnell involvement and the broader amendment of the general terms that CBA and BankWest have been through in recent times, I've had involvement in that process.
And in your own view of, in your own experience, the changes in relation to unilateral variations, is that something that has a positive impact on the treatment of customers?
Could I answer the question slightly different way? I think unilateral rights to change the terms and pricing, absent any sort of evidence of credit deterioration or other things like that, which is why I like financial covenants, because that's sort of evidence that you can use, I find hard to justify. That's a personal view. I think we've recognised that below 3 mil, but I'm not sure it's particularly different above that. But as I said, that's a personal view.
And in fact, you might say that Mr. Weller's circumstances weren't that significantly different from someone under $3 million. It was one property, it was one business that he was running, yet a limit of $3 million would have meant that those sort of protections aren't in place for him.
But I don't think the unilateral changes were an impact on Mr. Weller. I mean, I think that's quite different. I think in Mr. Doherty's case, that might be a factor that you will probably take me to, but in Mr. Weller's case, I don't think they were relevant or used at all.
Because? Can you expand your answer?
We didn't make any amendments or any changes relying on those clauses. The changes that happened were as facilities were renegotiated and renewed. I'm not aware with Mr. Weller that we actually triggered a pricing increase or a change to the terms unilaterally relying on those clauses.
Thank you.
Can I ask you some questions now about Mr. Doherty? You've heard, you were here in the commission, I think you said you were here when Mr. Doherty gave his evidence this morning.
That's right.
And in fact yesterday evening as well.
That's right.
Obviously, this is a complex case, and we won't be able to deal with all of the issues that arise, but I'd like to take you to some aspects of it, if I may. The facility to fund the hotel construction was entered into in, I think there might be some dispute as to the exact dates, but it was either 2008, 2009, in any case before the construction commenced, is that right?
Some of the construction may have commenced. Some initial work perhaps was funded by the company before the loan was drawn down, but fairly close to the start, I think is correct.
And in fact, BankWest had provided a facility to Mr. Doherty beforehand, or at least to Mr. Doherty's companies, hadn't it?
That's right.
And those facilities were advanced to Mr. Doherty's companies before CBA acquired BankWest, is that right?
That's right. I think 2007 they were
That's right.
advanced.
And from your review of the material, there were no obvious concerns in relation to the risks that might be involved in the types of development that Mr. Doherty's companies were doing at that time?
2007 you're referring to?
Yes.
I don't think so, no.
And Mr. Doherty's evidence is that he was introduced to BankWest by a Mr. Craig from JLL. Did you hear that evidence?
I did.
Is that a common way in which business is brought to BankWest or in fact to CBA?
I think both consumer and business banking brokers are involved, and I think effectively that gentleman was performing a broking type role. I think there is a specific channel within the bank that deals with brokers, so it's not uncommon that would happen.
Now, Mr. Doherty explained in general terms, although we came at the start of his evidence and we return to the issue today, the difference between in one line and mixed use valuations. Now, putting aside the specifics of this case, do you agree broadly with what he said about the differences between those two methods of valuation?
I thought, listening to Mr. Doherty yesterday, his description of the differences was as good as it gets, so I think that was, I'm happy to rely on that description.
Thank you. And you, no doubt, from your experience, are aware of the differences, the difference between those two forms of valuation?
I'm a lot more aware of the differences today than I was a few weeks ago, but I am aware, yes.
Now, do you know of, no doubt you do know of Knight Frank?
Yes?
Do you know a Mr. Page who performed two valuations in 2010?
I don't.
In your experience, does it matter when a valuation is performed by a valuer who's properly registered and provides the valuation? Is there a difference in the valuation depending on who engages the valuer to do the valuation?
I think banks prefer when we instruct valuers. I think the scope of the valuation is important. I think the extent of it, the scope, I think is banks have their standard sort of things that they require. I think sometimes clients will get sales valuations, short form valuations, other types of valuations that may not necessarily be adequate from a bank's perspective.
Now, Hadley's and in the Collins, the combined development, was valued a number of times between 2007 and 2011. There's just, for present purpose, I want to focus on two of the valuations. There'd been a valuation of the property which Mr Doherty described as a check valuation. You recall?
I
his
do
evidence
recall
about
that, yes.
And in fact, I might take you to that valuation. It's at PNC 5, which is CBA.0001.0319.4980. You've obviously seen this valuation for the purposes of preparing your evidence today.
I have.
And you recall, if one goes to 0.4984, you'll recall we went to this particular page as a summary with, and I'll ask that the table be blown up if I may. This valuation was done in August 2008, and as I understand it, it was done for the purposes of BankWest deciding, amongst other factors, on whether or not to enter into the facilities with Mr Doherty.
That's correct.
And from reading this summary, you'll see that the in one line valuation that was given was $53.5 million. Do you see that?
I do.
Now, if one looks at there's various other permutations, if one looks at the Collins Street alone in one line valuation, do you see that that is $39.7 million?
I do.
And you'd agree that if you look at the gross realisation, the final figure, Collins Street gross realisation of lots level 8 as residential apartments, that has a valuation of $49.39 million?
I do. Can I help, perhaps, Mr Donnelly? I recall the conversation you had with Mr Doherty around this table, and I agree with where you got to on that. So
Thank you.
15 plus 49, 74, 75 as a mixed use.
I think you might find 64.59 million was
Sorry,
the...
64.
That,
But I agree with that.
okay, thank you. And your evidence, is it not, is that BankWest relied on the in one line valuation for the purposes of determining whether or not to fund Mr Doherty's facilities?
I don't think that's probably a fair summary of my evidence.
Paragraph 20 of your statement, you set out the valuation, or you've summarised the valuation there with the figures that we've just got to and that you've agreed with, $53.5 million and $64.59 million.
Yes.
And I might have misled you in this regard. I think I was relying on what you'd said in an earlier draft. But is it the position, or do you accept that the bank relied upon a higher figure than the in one line valuation? Is that right?
I think the bank's view about this changed over time, so I'm just reluctant to give you a yes or no answer to that. So I think In the credit paper that followed the CBRE thing, I think it's fair to say that BankWest used the multi-use valuation that Mr. Longmuir, I think, who was writing that paper. So I think the bank did accept that. That's what he put forward, and that was what was approved. I think subsequently, from what I've seen in the files, the bank appeared to change its mind.
Can I just return to 2008 though, and we'll come to later, of course, and I accept you weren't there, but the use of the mixed use amount as at 2008, that would be consistent, would it not, with the evidence that Mr. Doherty gave about what Mr. Longmuir had told him as well?
Well, I object to that. Perhaps he could be asked about what Mr. Longmire told to him, because there's various different bits that Mr. Longmire is alleged to have told to him.
There's
This
a
would
deal
be
of
a bit
baggage
fairer
in the
with respect.
question. Mr. Donnelly might do better, I think, to unpack it or rephrase it.
Thank you, Commissioner. You heard Mr. Doherty's evidence in relation to discussions that he had with Mr. Longmuir, his relationship manager in 2008. Do you recall that Mr. Doherty gave some evidence about that?
I do.
And he said, or perhaps if I can go to what Mr. Doherty says in his statement, which I understand was consistent with what he gave orally, but essentially, in essence, it was that he said that Mr. Longmuir had said to him that BankWest had accepted the mixed-use valuation of $64.59 million during the loan approval process. Do you recall the evidence that Mr. Doherty gave to that effect?
That's not what I heard Mr. Doherty say.
He said, in his oral evidence, he said that he said to him, "It is what it is." Do you recall?
I recall those words, but I think the relevant comment around Mr. Longmuir was Mr. Longmuir had said if we didn't use that, he would have to go back to credit, which I think is at odds with what I remember in Mr. Doherty's statement, where he said if we used in one line, the deal would not proceed. So quite different was my take.
But is it right to say, am I right to say that and we can go to the relevant approval if you wish, but that approval, at least in 2008, did proceed upon the basis of the multi-use?
That's true.
Thank you. And is it also right to say that at least when we came to the second valuation that I'd like to deal with, the July 2011 valuation, and you'll recall that's the one that was done by Jones Lang LaSalle, and that was done on an in-one-line basis, wasn't it?
So I understand, yes.
Is it your evidence that the bank, by the time it got to July 2011, took a different view as to what was the appropriate valuation of the properties?
It's not entirely clear to me, Mr. Donnelly. I think what I did see from the credit papers was that earlier paper we just talked about, the bank accepted the multi-use valuation methodology. In subsequent ones, it does appear that the bank wasn't prepared to do that and wanted in one line as the valuation methodology. I don't know why that changed. I could perhaps provide some help in the bank's general view about multi-use and how we actually proceed with transactions, if that helps.
We might come to that, but if I can understand, but you accept that if a valuation is done in one line, it leads to or at least in this case, it leads to a significant lower valuation, doesn't it?
In general terms, I'd not agree with that. Specifically in relation to this matter, I think that is true. it's not a general proposition that it automatically flows to be the case, but in this case, I think that is a true statement.
Can we just unpack that a little bit? So I understand what you say about this particular case, but can there be circumstances where an in-one-line valuation can achieve a higher figure than a multi-use valuation?
I'm not a valuation expert, but my understanding is yes. I mean, there can be circumstances where in one line is the best way of selling something. It may be, I'm thinking of an example. You could have a terrace house split in two. So you could have, if you tried to sell them individually, you may get lower than if you sold them as a combined. So there's an example.
And
A very rough one, where in one line could actually give a higher result.
And what I'm trying to explore with you, though, is that, so applying that analysis, though, in this particular case, though, you would accept that a multi-use valuation would lead to a higher value than a in-one-line valuation?
I simply rely on the evidence I've seen, that valuations that were undertaken, and there were a lot of them, they seem to indicate that the multiple use valuation was a higher figure than the in one line in this particular matter.
And there may be circumstances, and akin to the answer you just gave previously, where it might be the opposite, and we can put that to one side, it doesn't arise here. But the relevant difference that was identified in the check valuation, that was done by CBRE, by Mr Grieve in August 2008, resulted in an $11 million higher valuation if it was done as a mixed use rather than as an in one line. That's right, isn't it?
That's what the valuation said, yes.
And you're also, the valuation that was done by JLL, perhaps if I can go to that, is at PNC 22. And no doubt you've considered this this document for the purposes of preparing your statement.
I have.
Now, Jones Lang LaSalle was asked to value the property on an in one line basis. Is that right?
I'd probably prefer to go to the instructions to see if that's actually true. I'm not doubting that, but...
Yeah, so, and in fact, there's quite a number of documents, but if one goes to the document ending 1990, that's the appendices, and you jump ahead 2 pages, you find the letter of instructions and standard terms conditions. And in fact, it might be easiest to do it in chronological order, which means we start from the back. But 1998 are the actual instructions that were provided on the 18th of March 2011. And Mr Craig, if one goes to the substantive text, you are requested to carry out a valuation on our behalf of the above property in accordance with the following instructions. Now, there's no reference, or perhaps I'll take you through it, but the reports to be provided, you see how it's there, it says, please provide 1 original report and 1 copy for release to the client. Do you see that?
I'm sorry, where's that?
About halfway down the page.
Yes, I do.
but the valuation wasn't given to the client, was it?
I think that's correct.
So the basis of the valuation was described as current unencumbered market value. So if you see just about point 7 of the page,
Yes?
and it's Hadley's Hotel as is, subject to the existing management agreement, and Inner Collins as is and as if complete, and then at the end, and in one line. Do you see that?
I do.
Now then,
I don't want to be pedantic here, but "and in one line," does that suggest?
no, we'll have to come to the later correspondence because I think there was, because the next, if one goes to 1997, this might assist in resolving the query that you raise. So this is some months later, and there was evidence that it took some time for the valuation. Let's leave that to one side. But Mr. Craig said, "Hi Nicole, as discussed, we will value the property on the following basis: as a freehold going concern in one line comprising all elements of both Hadley's and Inner Collins." Do you see that?
Yeah.
And then same as, and then number 2 was same as number 1 above, but excluding the following components, and there's some components set out. And it then goes on to say the number 2 scenario would require strata title being available, and I will ask one of my Melbourne-based colleagues to quote on valuing the elements. Do you see that?
I do.
And then on the next page, there's a response from BankWest, or Ms. Tatalia, from her to Mr. Craig. Thank you for your email and time today. Do you see that?
I do.
And it says, instead of proceeding with option 2, can we discuss a further scenario to include Hadley's Hotel and the conference areas and all commercial areas? And I understand the proposal is for these areas to remain under ACOR management. And then it says, as I understand the in one line valuation for the entire complex is now complete, I would be happy to receive this valuation. However, would like to discuss a further fee, quote, time frame and information requirements for an addendum. Do you see that?
I do.
Now, then going to 1993, the bottom, Mr. Craig indicates before issuing the final report. So this is on the 26th of July. And it was ultimately signed in July, but I don't think our research has worked out exactly the date, although the valuation was produced as at the 26th of July. There's a reference, I wish to confirm the final base of our valuations for the Hadley's Hotel and Inner Collins. And the first is that all elements, leaving aside what's in brackets, contained within Hadley's and Inner Collins operated as one consolidated concern in one line. As instructed, this valuation will be hypothetically done both subject to the ACOR management agreement and assuming vacant possession. However, we note that subsequent to our original instruction, Mantra has been appointed to operate the Inner Collins development, and our valuation does not take this into account. Do you see that?
I do.
And then 2, all elements of Hadley's Hotel plus conferencing only elements of Inner Collins operated as one consolidated going concern in one line. and that would be done subject to ACOR management and assuming vacant possession. So they're the two. The first is sort of everything in one line,
Yeah.
and on the basis that ACOR would manage everything, whereas, and we'll come to this shortly, Mr Craig notes but doesn't deal with the fact that Mantra could manage Inner Collins. And then the response from Nicole is, thank you, that's great. I tried calling earlier to obtain verbal confirmation of the value under option 2. Can you call me when you're free to confirm? And then if one goes to 1992, Mr Craig says, we have been focusing on the Hadleys plus Inner Collins conferencing valuation and have not obtained the Mantra forecasts. In any event, they would not be a like with like comparison. The ACOR forecasts I have are for HH and IC operated as one asset, whereas the Mantra forecast would relate to running Inner Collins as a standalone operation, excluding the conferencing components, of course. This would make it another basis of valuation, and above that we have been instructed to carry out at this point in time per my email below. You see that?
I do.
And then the bank says, agree with your comments. Can you advise the valuation of Hadley's only per valuation 2 as soon as possible? And then the report itself was provided. Now, as you know, the evaluation that was provided, if one goes to point 1887, it valued, and perhaps if I can ask it to be blown up, there's 2 market values as if complete. And one sees that the in one line valuation is $55 million. Do you see that?
I do.
Assuming vacant possession. And presumably in answer to the email we've just seen from Ms Tartaglia, then we have another one which is all of Hadley's and the conferencing areas only. That's $20 million. You see that?
I do.
Now, the bank was aware at this time that, Mr Doherty had raised on a number of occasions, I think it might even be fair to say that he was badgering Mr Craig, the bank, regularly about the fact that he was concerned that this valuation was going to be performed in one line, wasn't he?
I don't think I'd use the term badgering Mr Donnelly, but I think he was frequently pursuing that view and sharing it.
That is a kind of you to describe it, and that's probably more accurate. And he said on, and I won't take you to these emails, you refer to them, I won't take you to all of these emails, but if I can just take you to a summary of it perhaps in Mr Doherty's material at MED 13. And Mr Doherty says there to, on the second page, point 0203, he says, read the valuation. We're not trying to be difficult in any shape or form, but like you, we just want it done as soon as possible and make sure that it is the right valuation. My only concern with Craig doing the valuation is that he can only do it in one line. As he told me, he doesn't do strata title units. If we go with option 2, which looks like the most likely scenario, we will then want somebody else to value the strata title units. You see that? Mm-hmm. And he made similar He expressed his concern in a number of later emails too, didn't he?
I think that's correct, yes.
And it was Mr Doherty's position that the true potential of the property would only be realised on a mixed-use development valuation approach, wasn't it?
I understand that's the case. Perhaps it's a good time to come back to my offer I made previously about explaining how banks think about mixed-use development, because there are some permutations of that that are relevant here, I think.
Yes, and I don't want to stop you from giving relevant evidence,
So just quickly, so the valuation is one thing, and I'm not a valuation expert. It's, you know, we have 2 or 3 of the top valuers providing these valuations. For banks doing mixed-use development, though, one of the things that we would be very conscious about for apartments, penthouse-type sales, is pre-sales. And in the current market, you know, we generally would require 100% of those pre-sales to be contracted with deposits before we would lend against them. So a valuation is one thing. It's not the same thing as saying that's what the bank would happily lend against. I just wanted to make that distinction. So in terms of the multi-use development in this particular case, you know, there were various permutations, I think, that Mr Doherty looked at in terms of penthouses and apartments and various other ones. But for us to be comfortable lending against those, we would normally require those contracts or those pre-sales to actually be contracted rather than just a valuation on its own.
not to be difficult, and you are explaining it, but you've accepted, though, that in this particular case, and I accept not only is 2008 a long time ago, but so is the relevant time we're talking about now, 2011. But in 2008, you did, however, that is BankWest, you've conceded, accepted the mixed-use valuation as a basis upon which to borrow.
That absolutely is true. I guess I'm trying to explain, I think, why the bank shifted to in one line, why there was this divergent sort of change from the bank's perspective through this process, and I think that's part of the explanation, I suspect, behind that. I don't know. I don't have any facts or around that, but that strikes me as one of the reasons, perhaps, that the bank kept insisting on in one line as being the appropriate basis.
You'd accept, though, that at this time we're very close to completion of the project. In fact, the certificate of occupancy was issued the month after, wasn't it?
I think that's true, yes.
And I think, to use your language, if I may, I mean, one might say that a lot of the risk that existed in 2008 has been de-risked by the fact that the development is now at an end, isn't it?
Well, it's not quite an end, but the risk has diminished significantly. Yes.
It has. And Mr Doherty's evidence was that once this valuation was obtained, he was told that he was in breach of the LVR. Do you recall his evidence to that effect?
I think that was what he said, yes.
And do you accept that the basis for that breach was the JLL valuation?
I can't recall whether we actually called that as a breach specifically in relation to this matter. We may well have. I can't recall.
The valuation itself... Sorry, just to return to that before moving on from that. Sorry, is it your evidence that you're not sure whether or not Mr... from your review of this material, you're not sure whether or not Mr Doherty was told that there was a breach of the LVR? Is that...
I think what I'm saying is I'm not aware we called the breach of LVR in a formal notification. I think Mr Doherty's evidence was around a conversation he had with someone. I'm not disputing that. I'm just unsure in my mind whether we actually issued a formal letter of LVR breach.
There were letters that were ultimately issued because by then the tranche 1 facilities had expired, so there was a demand for payment that were made, and they didn't refer to LVR, they just required the repayment of the expired facilities.
So I just wanted to be clear about your question. You asked me whether I was aware of the LVR breach being communicated with Mr Doherty, and I heard his evidence that he was told verbally by someone in BankWest. I'm not disputing that. I have no basis to dispute that. I was just questioning whether we'd actually formally sent a notice of breach.
That
wasn't clear to me. So.
Yeah, and I understand your evidence in that regard, and you are right that there was no formal notice on that basis. Rather, the notices were issued on the basis that the facilities had expired and required repayment. The valuation, have you considered in the course of preparing your evidence the valuation prepared by Mr Craig in detail?
In detail would probably be more than I provided. I've read through it, I think.
Yes. Are you able to assist the Commission by explaining why BankWest at the time didn't use CBRE, who had completed the earlier valuation?
I don't know.
Can you explain why Mr Craig didn't deal with the previous method of valuation?
I don't know.
Now, Mr.
Just before you go on, Mr Donnelly, can I just try to understand this a little better than I am? At this stage, the facilities have expired, is that right?
That's correct.
The valuation is sought in connection with, using that as a very broad term, in connection with discussions about whether there will be an extension or new facility. Is that right?
I think that's true, yes.
Therefore, what is the, I was going to say the purpose of the valuation, what's the relevant basis of valuation that bears upon whether to extend or renegotiate the facility?
I think, Commissioner, there are probably two factors that would be relevant. One is the actual valuation and what is our loan to security margin. That would be relevant. I think the other issue is actually helping with forecasted cash flows, because as part of the valuation, a valuer will look at what he thinks this asset can generate in terms of cash flows. So I think that's also a relevant piece of information that we would like to use.
Because there are, my question's prompted by two probably disconnected observations that may themselves be misplaced. I see the email chain passing between bank and valuer about basis of valuation. Do I find in that set of communications any clear articulation of what the bank is asking the valuer to do?
I think it's confusing to me when I read the scope. I think in the subsequent emails it's the bank's toing and froing in one line, plus have a look at these other sort of permutations. I think when I think about the timing of this, the facility has expired. It's not as though we're looking for the valuation to provide us with some trigger, in a LVR covenant breach. That's not. From the bank's perspective, it really wants the most accurate valuation, I think.
And the second and, as I say, probably disconnected thought is, what's the customer being told about the valuation process, and what the bank is looking for the valuation to inform them about?
My understanding, Commissioner, in this particular case is Mr Doherty was concerned about exactly what the bank was asking for in terms of in one line rather than mixed use, and he was very open, I think, in his views about the basis that the valuation should
He had a
take.
view and he made it quite plain to
Very
the bank
clear.
what that view was.
And so there was toing and there was open discussion around that. I guess at the end of the day, I sort of look at this issue and it sort of seems a little moot to me, because I'm not sure at the end of the day it was actually relevant to the outcome here. And I don't know whether the valuation should have been in one line or mixed use. I'm not qualified to respond to that. What I do seem to see from my review is it actually didn't have any bearing on the outcome.
You'll need to explain that more to me than you have so far, I think.
Perhaps if I could try and do it very briefly, and I'm sure you'll tell me if I'm not successful.
There's a chance of that.
So I think the facility had expired. Why didn't we renew the facility? And there's some evidence I think we've brought to that point. The high LVR was certainly one of those things. The LVR breach was just indicative of high LVR. It wasn't in itself the reason that we didn't renew. It was concern about the creditors, the time that would take to get this done, where this was heading. The information we were getting from the Doherty Group, there was a lot of concerns, I think, about we just didn't feel we had a good understanding of the borrower and these issues, the credit deterioration that we were seeing, that we didn't want to renew the facility. So the LVR in itself was a factor, it was relevant, but it wasn't the reason. It wasn't because of whether the valuation was 75 or 65 that was determining whether we were going to extend this loan. I think the other factors were more important in this particular case from what I've seen from the file review.
Thank you. Yes, Mr. Dinelli.
Can I explore just two further issues? Just in relation to that, you knew that there was a certificate of occupancy in August 2011, don't you?
Yes.
And you've heard Mr. Doherty's evidence that he was waiting on the $3 million that would be paid on execution of a management agreement by Mantra.
I heard that, yes.
And the bank was aware, was it not, that Mr. Doherty was in financial difficulty, or his group of companies,
I think that's true, yes.
and that he owed money to the ATO,
Yes.
and that he required those funds to finalise the hotel so that it would be ready to, so that Mantra could commence operation.
I heard the evidence, yes.
And it was BankWest's position that it wasn't willing to sign the management agreement.
So I think
The tripartite agreement, I should say, I'm sorry.
is this the non-disturbance
That's right.
agreement? That's correct. BankWest weren't prepared to sign it.
And you've heard Mr. Doherty's evidence that if that $3 million had a flowed, that would have been sufficient to discharge his debt to the ATO.
I did hear that, yes.
And various other debts, such that the Collins could have commenced operation under the Mantra name.
I heard that evidence, yes.
And the refusal of BankWest to sign that agreement had the effect that that wasn't able to happen.
Well, there's a long sort of build-up of subsequent events. I think the refusal of BankWest to sign that non-disturbance agreement stopped the Mantra agreement from being signed. I think that is a fair comment. Can I touch on why we would have refused to sign that non-disturbance agreement?
Of course.
For a secured creditor, effectively postponing our rights to the operator of the hotel, that is what was required under a non-disturbance agreement, basically means we can't, if we were to sell that asset, we can only sell it to the holder of that, who has the benefit of that non-disturbance agreement. And that's something we're very loath to do. That creates one buyer, effectively, and that goes to the value of the security. If we got a valuation on the basis of only one potential purchaser, that would have a significant impact on valuation. So that's something that we're very loath to agree to. Not just in this case, but as a broad general comment on hotel-type non-disturbance agreements.
Excuse me just for a moment. I'm not sure if it is. Okay, yeah, we can do that. Excuse me, sorry, Mr. Clark.
I'm happy to stop any time you would like, Mr.
I'm sure. I'm sure you are. Can I deal with briefly going back in time? As a result of Project Magellan, Mr. Doherty's file was listed as double red, wasn't it?
That's correct.
And would it be fair to say that Project Magellan saw a significant shift in the attitude of the bank to risk generally and also specifically in relation to Mr. Doherty?
I wouldn't agree with that comment. I don't think Project Magellan resulted in any significant shift in risk. I think Project Magellan was a result of a perception or a concern that the risk had already shifted in the book that was being looked at. I forgot the second part of your question.
No, then I said specifically. It resulted, did it not, in ultimately the appointment of investigative accountants?
You will get much more fruitful evidence on Magellan, I suspect, from subsequent witnesses, but my broad understanding, I think there are 1,000+ files reviewed in Project Magellan, which was, 10 or 20% of the BankWest portfolio. So it wasn't the entire portfolio, but there was a significant material part was reviewed.
And just finally, can I just go back to the period in about August 2011? The hotel obviously didn't operate during that period until January 2012.
I think May 2012, I think the hotel
I see. Well,
opened.
the receivers were appointed in January.
I think that's true, yes.
And in fact, the receivers sought some further funding from BankWest soon after their appointment.
Yeah, I think the receiver overdraft got up to almost $4 million, I think.
And in fact, ultimately, the receivers appointed Accor to operate the Inner Collins, and it opened in 2012. Is that right? April 2012.
So I'm not aware who they appointed to manage it, but certainly May 12 is my understanding of when it opened.
And it operated for about a year before it was sold.
I think there was a endeavour to bed in the operations, I guess, before the sale process commenced.
And ultimately, and this Commissioner answers a question that you put previously in your evidence. You set out what the property sold for.
You're not going to ask me for the sum of those, are you?
No.
They are in my statement.
Thank you, and it's my way of assisting the Commissioner through you, Mr. Clark. If you go to paragraph 85.
I should apologise. We should have totalled them, I think.
No, that's fine. So perhaps if I can ask the paragraph 85 to be put up on the screen of Mr. Clark's statement. And the relevant property sold in September 2013, Hadley's for $8.325 million and Inner Collins for $24.9 million, is that right?
That's right.
Ultimately, BankWest suffered a very significant loss on this file, didn't it?
We did, yes.
And what was that loss?
Something in the order of 38 million, I think, $38 million.
No further questions.
Yes, thank you, Mr Hodge. Mr Stapleton, do you say you have, if you have no questions, we needn't get to any question of leave, need we? Ms Collins.
I have no re-examination, Commissioner.
Yes. Thank you. Just before you leave the box, Mr Clark, a question of more general application, take it away from these two particular case studies. A facility comes to its end, the bank, for whatever reason, decides it does not wish to renew that facility or negotiate a new term with the customer. You're able to identify what would be important considerations which might affect whether refinancing that debt would be realistic?
So two things jump to my mind to respond to that question, Commissioner. One is a return question. So is the pricing on the facility or the lending transaction for the risk involved and the tenor the client wants, is that providing an acceptable return to the bank? So it may be that for whatever reason it's suddenly less attractive commercially to that current lender. Whether that's the case for every other lender or whether it would able to easily refinance is a question, I think. But that would be one reason why lenders would decide they didn't want to roll over. Competition in that particular industry or sector may be intense and therefore they weren't able to get the returns they wanted. Their cost structure may be out of line, a whole host of reasons, but returns could be one. The second one, I guess, is credit deterioration. So if a lender was of a view that the credit had deteriorated or was going to deteriorate in the future and that therefore they didn't want to continue with that client, that would also be a factor. The third one that jumped to mind as I was articulating the first two responses was the relationship. So it may be that the relationship with the client sometimes breaks down and it may be the trust and the understanding between the bank and the client is not, from either side, not where it should be, and so the bank may decide to let it go at that stage.
Yes. Does anybody have anything arising out of that exchange? No? Thank you very much. You may step down and you are excused.